Here we go. All right. Let me share screen here and we'll get going. Those of you that have been on these calls regularly on Wednesday, by the way, we just crossed over our 1-year anniversary of doing these Wednesday calls with zero fanfare or celebration, which is okay. But ironically, this was the very first topic for the first Wednesday training that we did. And interestingly, when I went back and prepped some material for this Wednesday's course, I had some loan estimates and closing disclosures that we used for the very first training on March 9th, 2022. And the rates were a lot different. I had a VA example at 2.5%, and I had an FHA example at 2.5%, and I had a conventional example at 2.99%. So these are going to be much different rates, of course, and updated. The good news is we are seeing rates really fall rapidly this week. I'm going to get some information out to you guys later today that shows that we're dropping solidly into the low sixes, high fives. So a couple of weeks ago, I said, I think we've seen the top. I don't think we're going to see 7% for a while. And hopefully that will hold true. And we'll be able to engender some more excitement in the marketplace about stability of rates. So this is not going to be like our standard Wednesday trainings where I have a PowerPoint and I talk through. This is really just 3 different examples of loan estimates that you'll see on the screen here, and then a breakdown of what you will see in categories. So in order for this to work well, you guys are going to have to be as interactive as possible. There are no dumb questions when it comes to reading these forms. I don't expect you to know everything on these forms. Your clients don't expect you to know everything on these forms, but this is a great everything you want to know about closing costs, but we're too afraid to ask environment for us to talk about how home financing works in this context. So please feel free to jump in the chat or just flat out interrupt me. And hopefully you can walk away today with a much better understanding of what goes into closing costs. Any questions before we get rolling, y'all? Okay. Well, this is what a loan estimate is going to look like. We're going to start with conventional. And there are 2 key forms that are required in the mortgage transaction that you have probably heard. Number 1 is a loan estimate, which is delivered to your client within 3 days of the lender receiving the purchase agreement, right? That's going to lay out, sometimes called a good faith estimate. That's on the front end. So loan estimate is first, and then a closing disclosure, which is almost an exact duplicate of the loan estimate, which is required to be delivered to your client and signed within 3 days of the closing date. We're going to talk through the loan estimate just because that's what I pulled. But if you have a good lender, you should have a very similar bottom line number where this loan estimate should line up almost exactly with the closing disclosure.
Colin, I have a question real quick.
Yes.
That closing disclosure within 3 days of the close date. So like if you're 3 days out and your client hasn't signed, then what? Or like if you're approaching 2 days until closing.
Yeah, you can be stuck if you don't have a forward-thinking lender. That's one of the common challenges that came out of TRID. Everybody heard of TRID. You remember when TRID went into effect about 5 years ago, is that it required the closing disclosure to be delivered to the client and signed 3 days before you can fund. Well, a lot of lenders were not prepared for this, and quite frankly, still are not, where they will wait until the loan goes clear to close, and then they will issue a closing disclosure. Well, guess what? If you've got a slow lender or you've got a 24-day contract, you don't have time to wait for the loan to be fully approved and then issue a closing disclosure. That's where a lot of the hangups come into play, right? I will tell you a little shameless self-promotion here. that we're in the habit of, as soon as a loan goes into underwriting and comes out of underwriting, the closing disclosure goes out, so that cooling off period begins. But yeah, Angie, if you, depending on the lender that you work with, that closing disclosure may not go out until very late in the game. And that can cause delays with closing if you haven't satisfied that 3-day period from CD to closing and funding date. Does that make sense?
Yeah, so you can have them sign earlier, like more than 3 days in advance. It just has to be 3 days before closing that the signature has to be on. Okay.
Yes. Yes.
Okay, thank you.
Very good question. Anybody else run into this where they're like, the loan's approved, the lender's telling me the loan's approved, but they said we can't close for another 5 days. Like, why is that? Austin Hardy said, yes. Austin, do you want to, elaborate at all or tell a horror story?
I had one where they like couldn't even send out the closing disclosure yet. There was issues, to say the least, but then it pushed it back, and then it has to go through this cooling off period, which I don't understand one bit if it's clear to close and this is signed, but it definitely delayed things. So the fact that you guys send it out in a timely manner to avoid that issue is nice.
Yeah. Anybody want to take a crack at what the number one delaying issue with issuing that closing disclosure is?
VOE, the final VOE.
No, VOE does not affect this. That's a really good guess, though. It's actually homeowners insurance.
Oh, good. I guessed it.
Let's go. We're on a roll today, Hannah. So, yeah, homeowners insurance, if you work with companies that, I'm not going to name names here, USAA, Allstate, like some of these big companies, Geico, where they do not get back to you in a timely manner, then the closing disclosure can't go out because the lender is sitting here like, we have no idea what their homeowners insurance is going to be. And that's all over the CD. So that's one of the nice things. If you guys have worked with Joe Rosensteel and his team over at Insurance Resource Group, that sort of synergy comes into play really nicely. I've gotten insurance binders from Joe in which he's not even, represented the client just to satisfy this condition. So yeah, homeowners insurance is like, I'm going to shop around for homeowners insurance. And before you know it, you're 6 days from closing and you're like, I need a binder right now. So good job, Angie. And that was really, really good, accurate guess. All right. Sorry, I got on a tangent. So this loan estimate, this is obviously you've got applicants' names and the property redacted for privacy purposes, but this is a good example of a recent loan estimate for a sale price of $375,000. This is 15% down. You got the interest rate here. I told you we were under 6%. You've got principal and interest here. Prepayment penalty, that's a question that I've gotten a lot recently. And prepayment penalties are by law not permitted in the state of Minnesota. So you're always going to see a prepayment penalty here. And then a balloon payment. Anybody want to tell me what a balloon payment is?
I think you have to pay it later at some time, like it blows up. I mean, it's a big dog at some point.
You're right.
Final payment.
Yes. Yeah, exactly. So let's say that you've got a loan that's on a 60-month balloon. That means that you have to come up with the entirety of the loan balance as it stands after 60 months. Now, you can do a lot of different things to tackle that, but those are often seen on land deals, for example, where you have a land loan that has a balloon payment because whoever's issuing that loan wants you to build on the land. So they'll have a balloon payment and say, hey, we'll give you this. This will be interest only, but the bill's going to come due in 48 months. And then you have to come up with the entirety of the loan balance at that time. Projected payments you're going to see here, principal and interest on the loan, PMI, and then your escrow. So an escrow is going to include property taxes and homeowners insurance. It does not and will never include homeowner association dues. So when you talk about what goes into a mortgage payment, principal and interest, PMI if applicable, taxes and insurance, and then the HOA dues are still counted in the client's debt to income ratio, of course, but the HOA payments are always, always, always made outside of the mortgage. So this escrow account will reflect 1/12 of the county tax value and 1/12 of the homeowner's insurance value. Move down here, you've got closing costs that will break down into loan costs and other costs. And then you've got an estimated cash to close that is reflective of what does the client need to bring at closing. We're going to dive into what that looks like here in a moment, but this page 1 is a bunch of Harvard MBAs that got together in 2018 and said, what's the best way to represent what a loan estimate should look like? And it lays out what the monthly payment is and the cash to close. Those are, in my opinion, the 2 most important figures that a home buyer should be looking at. Questions on page 1? Okay, let's roll into page 2, which is going to be a more granular breakdown of what this looks like. Whenever I'm telling people, hey, you shop around for your rate, it's not so much about what the rate is, it's about what the lender is charging you. So anything in box A is reflective of what the lender is being paid in this transaction. This is where you're going to see discount points to buy the rate down, right? If this were Rocket, this would show 2.5 points or, almost $7,000 that is paid to the lender before you even get into appraisal and credit report and escrows and things like that. This is also where you would see an underwriting fee. You would see a processing fee. You would see various other, quote, junk fees that the lender will charge you in box A alpha. So a lot of lenders will slickly say, box A is what you owe us. Everything else goes to somebody else. They're not wrong. But section A is sort of that zeroing in point where it's like, okay, how much am I actually paying the lender to buy the rate down or facilitate the funding of this mortgage? Box B is where you're going to have services you cannot shop for versus section C, which is services you can shop for. All right, that's going to be like appraisal fee, credit report, flood certification, which is always 8 buckaroos, tax service fee, things like that. In other words, the buyer can't go and say, I want my cousin who owns an appraisal company to appraise my house. That's not going to work. You can't shop for, I want Advantage Credit Company to pull my credit. Well, the lender already has relationships involved with those vendors, so you really cannot shop for those services. But title you can, right? So that's where you're going to see things like the exam fee and the premium for the lender's coverage, which is the lender's title insurance, is going to pop up in section C, Charlie, because those are services the consumer can shop for. They can pick whatever title company they like. Then, of course, we love letters in the mortgage business. So you've got D, those are the loan costs. So if you talk about, well, how much is the loan cost, up here where it says $6,019, that is a culmination of A, B, and C, Alpha, Bravo, Charlie. Then you've got recording fees. Those are always going to be $92. You've got transfer taxes, which is known as the mortgage registration tax in the state of Minnesota. That is all based off of the loan amount, right? So you've got a higher loan amount, you're going to have a higher mortgage registration tax. Lower loan amount, lower mortgage registration tax. The same goes for the premium for the lender's coverage, right? That is all predicated on the loan amount. Section F is going to be prepaid on any kind of loan. you are going to have homeowners insurance that is due on day one and covers you through the first year of homeownership. So I'm a buyer and I'm saying, I want to buy this property on 123 Main Street, and I want to move into this property on May the 8th. Awesome. Okay. We're going to make sure that you have homeowners insurance that goes into effect on May 8th, right? Now that's to protect you in case your house burns down. It's also to protect the lender, to make sure that the property is appropriately covered in the case of something catastrophic happening, right? Go back to homeowners insurance, right? And Angie's great point about the effective date needs to match up. Sometimes when closing dates get moved up, it can be a bit of a scramble where we need to change the insurance effective date to match the new earlier closing date. Say, well, why does that matter? Well, because when you move in, you want to make sure that you're covered for homeowners insurance. The unique thing about homeowners insurance is that it is always paid in advance. So again, you're getting coverage with this 12 months from month 1 until month 12. So I would be covered through, let's say, IRG, Joe's group, from May 8th, 2023 until next May. Say, Colin, what happens next May? Well, my insurance will automatically renew because I'm paying 1/12 of my homeowner's insurance as part of my monthly payment. It gets put in an escrow account that's held by the lender. And then on my 1-year anniversary or renewal date, it's going to cover me another 12 months. Sometimes buyers can get a little bit confused by this and feel like they're paying way too much for homeowners insurance in advance. But the reality is, because you are paying a year in advance, that will end up putting you in a position where you are never uncovered from an insurance perspective. Does that make sense? Any questions on homeowners insurance premium? Okay. I want to talk about prepaid interest for a moment. So this is one where people will get a little bit confused, and I mentioned this in the team meeting yesterday about, if I write a closing date of May 8th, when will my first payment be due? Let's see if can you guys see my calendar when I pull this up here?
Yes,
Yes,
we can,
we can.
Colin.
Okay, perfect. So if you write a contract in the first 7 days of the month, all right, so let's say you're out and you have a buyer that wants a quick close and they want to close in early May, right? As long as the closing falls in the first 7 days of the month, think about it like a touchdown, 7 points, then the buyer can choose what their first payment date will be. It can either be June 1st or it can be July 1st. All right. Mortgage interest is paid in arrears. So if anybody just made a mortgage payment on April 1st, you are not paying for all of April's interest. You are paying for all of March's interest. It's paid backward, unlike rent. So because of that, you ever hear talk about skipping a month? Hey, you can skip a month, before you make your first payment. That skipping of the month is really just reflective of the fact that when you make your first mortgage payment, you're paying 30 days behind in interest. So roll through this with me for a moment here. This client's closing on the 8th of May. If their first payment is July 1st, they're covering all of June's interest, if you follow my calendar here, and then they are paying for May 8th through May 31st at closing. That's 24 days at $52.38 per day. So you ask me, okay, Colin, what if they closed on May 4th and they wanted their payment to be June 1st? In that case, this number would be negative and they would get a credit for the first couple days of the month that they are making up that they didn't live in the house. So for example, May 4th closing, they would get a credit for 4 days at $52 a day. This is actually going to be about negative $200 because again, that first payment that's coming up quickly on June 1st is going to cover all of May's interest except for the 4 days that they had not taken possession yet. So this can be a real advantage, especially with first-time home buyers who are exiting leases. And they're like, I do not want to make a mortgage payment and a rent payment in the same month. You know, you could say, well, you actually skip a month before your first payment is due. What do you mean? Well, I'll tell you what if we close on May 18th? You're not going to have a payment due until July, right? A lot of first-time home buyers do not realize that interest is paid in arrears and you have a grace period.
VA too, Colin.
Any kind of loan, jumbo, VA, FHA, USDA, conventional, you know. So, any questions about that? Does that make sense to you guys? Sometimes you just have to look at a calendar and determine what works best, but use it to your advantage when you're writing contracts. I always bring this up, you know, when is your lease done? Okay, well, you know, here's what we can do, right? One other thing. Mortgage payments are due in the first 15 days of the month. All right. So you do not have to make that mortgage payment on July 1st. If you want to make it on the 10th, if you want to make it on the 7th, if you want to make it on the 12th, you can do that. So not only do you have a grace period before the first mortgage payment is due, you also have a grace period within the month or any month that your mortgage is due that you have to make the payment. Questions on that concept of prepaid interest or interest credit closings?
I don't see it on here. Maybe this isn't in an HOA, but isn't there a difference on HOAs between conventional and FHA as well? Like, can't conventional be prorated to the date of closing, but FHA, like, seller's responsible for the month in which you close or something like that?
Yeah, correct. And that would often show up in prorations, which would be adjustments in other credits. You know, but HOA prorations will work the same way. You know, for example, let's say this property were in an HOA and you are going to owe the HOA proration from, let's use our same closing date, May 8th through May 31st, right? You're going to have 24 days of HOA proration as well. And depending on the title company, you might also have June's HOA collected. So whenever you talk about properties that are in HOAs, especially condos, you are going to typically have stuff that shows up in section H hotel that will be an HOA setup fee, which is really just, you know, a junk fee that the association is charging. And then typically 1 month association for that following month. So it becomes a little bit confusing because mortgage interest is paid in arrears, but HOA functions very much like rent, which is paid forward. So if you have a client that's closing on May 8th and they're in an HOA, for example, you might end up having to pay darn near 2 months of homeowners association dues at closing. And Cassie, you're right. I mean, that is handled by the title company in proration in terms of, I'd have to check on that. For FHA, for government loans, what that looks like on HOA proration. But I know you're onto something. I just can't remember how
Yeah,
it
I
works.
thought it was like conventional let you prorate it to the day, but FHA, like, basically the seller has to pay for that month and buy. I could be wrong, and I guess it's not really too important here.
Yeah, there's like a there's a credit, what do they call it on the title side? Gosh, I can't remember off the top of my head, but yeah, that's a really good point. Condos, Condos will always tend to be just a little bit more expensive because there are going to be a lot of things that show up in this other section, section H, hotel. Also, if you've had clients that are closing in March, you sometimes will have a lot of property taxes that go into escrow. This number can be 8 months of property taxes that's collected. Well, why the heck is that? Well, typically it's because you want to make sure that you have enough to make the tax payments, which are due in Minnesota in which months?
Angie, you're muted if you're saying something.
April and October.
I was
Very
saying April
close.
and October, but I was wrong. So I was keeping myself muted.
May and October.
Mm.
Angie, Deidre, you guys are very close. So May and October. So for example, if you close in March, right, then your first payment date is going to be May 1st, right? So that means only 1/12 of your taxes are collected as part of this monthly payment. And, you know, as such, you've got to make a 6-month, or really the escrow account needs to pay 6 months of your property taxes on May 15th, right? So you'll see, you know, 8 months in here because that's the 6 that's required, plus typically 3 months of cushion. You'll talk about these escrow payments at closing, which often are referred to as cushion payments, where why is the lender collecting not only 12 months of my hazard insurance, but they're also collecting another 2 months? The reality is that the thought behind that is if your taxes go up, if your homeowner's insurance go up, the lender wants to keep your payment as close to the same for as long as possible, right? Now, sometimes that's unavoidable. New construction where the lot is certified and then your payment's going to go up a huge amount with the property tax value, that can be challenging, right? But for the most part, this cushion in the escrow account is meant to keep your payment the same if your taxes or insurance were to increase. And then you got stuff down here, the owner's title policy, which of course is always optional, whether they want to buy a policy that protects them in the case of errors or omissions by the title company. Things like mechanics liens and deed errors and things of that nature. And then the real estate admin fee to EXP for $695. You go down here to calculating cash to close. You got closing costs of a shade over $13,000. The down payment that's required. This is a simple debits and credits exercise. This deposit reflects the earnest money, which will go toward the down payment or closing costs. And then your estimated cash to close, which reflects here. And that's the long and short of it on a conventional loan estimate. We've covered a lot of the guts of these things, which will serve as a good foundation for really quickly flying through FHA and VA, and then I'll let you guys go. But any questions on conventional before we move on to a quick government example?
I have a question.
Yes.
So I've been using the Flex Title, get a quote to give my buyers and sellers an idea for closing costs. Now, if I'm not able to use that or just want to give them a quick answer, what can you say typically if a buyer especially is like, how much are closing costs? Is it safe to say they're roughly between 2 and 3% of the purchase price?
Yeah, I mean, I would say check with your lender, but I think in this environment where points have become very commonplace, you know, I would say 3% is a good target. The other interesting thing here, Angie, is that it depends on the purchase price, right? Because this is a math percentage representation, right? If you've got closing costs on a $500,000 property, well, the appraisal fee is a much smaller percentage of that overall number. In other words, your closing costs will be a bigger percentage the lower your purchase price is.
Right. That makes sense. Okay, thank you.
But I'm
I
glad
have
you're
a
using that
question
calculator.
too.
That's
Oh.
a cool thing. Go ahead,
It's
sorry.
super helpful.
I had a question about where it says on the 695 for the BAC, it says realtor fee. I've seen this called many different things on these before. So who's in charge of like what that gets called? Because I think that's really confusing for the consumer when they're told there's no fee for the realtor and then they see that on there. I get that question every single time.
Yeah, I mean, sometimes it's called a real estate admin fee. Sometimes it's called a broker admin fee. As it's a junk fee for the actual real estate brokerage, it is disclosed every time in section H, hotel. It can have a variety of different names. I will tell you that when the consumer asks us about it, that's just a broker admin fee that is required by the buyer's agent's brokerage. That's what we will often say. But I mean, this has so many different things that it is called. Sarah, I think that's kind of your point, right?
Yeah.
Or
I've
I think
always
the
heard
point is
broker
we call it a broker admin fee. So then when title companies label it as something else, that's when the consumer gets confused. Is that your point?
Yeah,
Sarah?
that's what I mean. Yeah.
So I think like I actually personally haven't had that happen, but if you are doing that, maybe just reach out to the title company that you're using and specifically ask that they label it a broker admin fee or in alignment with whatever fee you're consistently calling it with your client.
Okay, got it. Thank you.
And what I will say too is we did, Colin, is this with UWM?
Yeah.
They did switch, the lender did, to where we used to type in real estate admin fee, and they did switch and they want us to be labeled as realtor fee.
But we can do whatever we want in reality.
Correct.
Like we can plug it in. I prefer broker admin fee. You know, and that's where too, like, you know, if you've got a good lender or broker that is walking through this with the client, which they should be most often, you know, hey, that's the broker admin fee. That's what eXp Realty is charging to maintain your records for X number of years, right? So that doesn't go to Sarah Church's pocket, is really kind of the overall spirit of the message.
Yeah, perfect. Thank you for explaining that.
Yeah, you bet. Good question. We'll just go maybe another eight to 10 minutes. FHA is going to look a little bit different. This will all look the same. The mortgage insurance, of course, on FHA is a flat number. It's not determined by credit score or loan to value. Doesn't matter if your credit score is 580, 680, or 780. It's always going to be the same number if you're at 96.5%. The only unique thing that you will see on FHA loans is that FHA not only charges you mortgage insurance for the life of the loan, they also charge you what's called an upfront mortgage insurance premium, which is 1.75% of the loan amount. So you think about this loan, it's $412,000. FHA is going to get you for basically half of your 3.5% down payment up front. That can be either paid in cash or 99% of the time is going to be financed into the new loan. Oftentimes when you see somebody say like, holy cow, my closing costs are insanely expensive, my first question is, what kind of loan are you doing? FHA. Okay. Well, did your lender explain to you that what's showing up in section B for your mortgage insurance premium, that $7,091, is actually being financed from your loan amount? And it's a little bit goofy the way FHA does this, but what they will do is they'll subtract that financed amount from what you owe in a down payment. So stick with me on some math here for a minute. This is $420,000 purchase. The borrower should have to bring 3.5% to closing, which is $14,700. In reality, why do I only owe $7,606? That doesn't make any sense, right? It's because they are subtracting what's financed from the loan amount, which is $7,091. That's really great right there. Sorry, if you can see my calculator. So when you talk about this upfront mortgage insurance premium, it's included as a closing cost, which, Angie, kind of to your point, you can tell a buyer one thing, but if you don't have a good broker on the back end explaining, right? I mean, this purchase price is $420,000 and you told them 3%, you know, that should be $12,600. My closing costs are $18,555. What the hell? Well, the reality is it's reflected that way, but you're actually getting a $7,091 discount on what you're paying in the down payment. Again, I don't love the way that FHA does this, but it really just takes somebody to explain that to the consumer to have your back, really, for lack of a better phrase. You know, if you're going to tell somebody, hey, closing costs should be this much, like, and you have somebody that has no idea how these numbers break down, it can end up making you look kind of bad. So that's the long and the short of the FHA MIP. Everything else pretty much the same. And then VA, to sort of tie a bow on this, is going to be a lot higher in closing costs if you have a veteran who is non-exempt from the funding fee. Veterans who have a service-connected disability will be exempt from the funding fee. If they're non-exempt, then they have to pay a funding fee, which is based on down payment, 0, 5, or 10+% down, and whether they've used the VA loan once or never before. It's called first time use, which is a little cheaper, and subsequent use, which is using it multiple times. This is an example of a $530,000 sale price in which the loan amount is almost $20,000 higher than the sale price. Hey, we're buying a $530,000 house and we got a loan for $549,000, right? Why is that? Well, it's because much like FHA, look at these closing costs. Angie, I mean, imagine you said, you know, it's going to be between 2 and 3%. And then they get this from the lender. It's 35 grand. Like, what's going on there? $27,000. This lender's ripping me off. What's going on? The reality is, just like FHA, there's a funding fee that's included in Section B Bravo, right? And then you will see that that is financed from your loan amount, where that $19,080 is rolled into the new loan amount. This is a cool thing with VA in which, you know, how are you going to get a credit for $5,000 at closing? Anybody want to take a stab at why that might be? It's a VA only situation.
Earnest money.
Exactly right. Yep, we've got a deposit here, which is earnest money of $5,300, right? And we've got a seller credit of 15 grand that we're using the entirety of, right? If you want to believe we're using the entirety of it, look at the rate, 5.577%, pretty darn good for VA. So we're using all the seller's credit, and the borrower, the veteran borrower, is going to receive more than $5,000 back, which is simply a refunding of their earnest money. But again, something to keep in mind, especially on VA and FHA deals, is that your closing costs will appear somewhat out of whack because there are upfront mortgage insurance premiums, whether they're called MIP for FHA or VA funding fee for VA. They're baked into those closing costs. Any questions on anything that we covered here today? Hopefully y'all learned something.
Definitely did.
Yeah, I love it. I love when you go through it so well, Colin. I love referring back to these videos too, just using them as refreshers later down the line too. So thank you for all of this.
You're welcome.
Hey, Colin, on the FHA, so you're allowed to ask up to 6%, but if you somehow got 6%, you can't, even if it's not all used, that just goes back to the seller, right? Or can you put it elsewhere on your side?
Correct. Use it or lose it. Right. So
You
if
can
you've got
get creative
excess,
with that. Sorry, you
Yeah.
can get creative with that too, Austin. I mean, that can go towards a home warranty.
Sure.
You know, buy downs. I don't know if that's such a hot topic anymore, but you know,
Can
there's
you use it to
additional
buy
ways.
it down? If there's just like a 1.5 extra, or does that not make sense?
say
Or
your
is that
question again,
really
Austin.
low? Like if you had 6% for an FHA deal and closing costs were 4%, you've got 2% from the seller extra just sitting there. Say you buy a home warranty, that's obviously not taking a whole lot from it, but like, is there a way to use it towards a rate buy down or something else, or?
Absolutely. Absolutely. Yeah. So, and we actually have a calculation where we will spend every nickel to buy the rate down within 1,000th of a point. So, for example, if you look at this, it's like, what the hell is this? Like 5.577%. A lot of lenders in the broker channel will go to the 1,000th. So, you know, this was representative of what's the lowest that we can do to use this $15,000 in seller credit, you know, and the rate that we had spit out at us was 5.577%, right? Now, if we end up not using all of this $15,000, we will buy that rate down a little bit more. But yeah, that is a terrific way to do it. You know, it really depends on what the client wants. But more often than not, the rate buy down is great. Matt, you just had this on a Hannah Knutson loan where, you know, we got to the end and the loan's fully approved. And it's like, we had what, like $4,800 or something to buy the rate down. The rate went from 7 something to like 6.7%. So yeah, you absolutely can do that, and should. The lender should.
Cool.
I'm going to get you guys, everybody on this call, a cheat sheet. I know we've sent this a couple different times, but in terms of what the maximum seller concessions allowable are, we have a co-branded piece of that. Holly, I think that Caitlin has that for us. It's somewhere in my email. Parker asks for it every couple of months. So I'll send you guys that. That can help in terms of, you know, structuring deals. And it's like, well, wait a minute. This is at 10% down conventional. How much can I ask for? And obviously, you know, in a hotter market, that's not going to be as much of an option, but you could just keep that and save that in your file and reference it when you're writing offers. Thanks, everybody. Really appreciate your time today, and great to see all your faces.
Thanks, Colin.
Thanks, Colin. This is great.